Okay, Walt Disney. Now about the industry. Is all clear about industry, guys? Okay, great. Let's go. So Walt Disney Corporation, or before it was actually called Disney Brothers Studio. Okay, and just a bit of history. It's very interesting to read. I love history of different companies, and definitely recommend you to read about it because you will understand the culture of the company, and quite a lot probably will come up from what kind of I read about how Microsoft was established, Dell. I love history of Dell, and Walt Disney as well. It's one of the probably best stories, and a lot of people are telling that look. It was created in 1923, but actually they were trying to start it before that. But in 1923, they created the first cartoon, which was Alice in Wonderland. But they didn't make any money, and sometimes they even didn't have money to buy paper. They didn't have money to buy food, so they were really struggling. And only in 1928 they started making money after they introduced Mickey Mouse. Okay, Mickey Mouse was a hit for them, and that's what kind of probably changed the history. I don't know whether survive or not if there wasn't Mickey Mouse there. After that, they kind of another big thing was in 1934, which was Snow White and the Seven Dwarfs movie, and then 10 years later they started their own Disneyland TV series. After that, they had few cartoons and movies, but that's probably created a huge advertisement for them because they started this Disneyland TV series, in our Wonderland it was called, and when it was growing, the popularity of these cartoons were growing so fast in movies as well that they decided to open the theme park where all these cartoons will be together and where kids can come and play, and that's how idea was born. And in 1955 they opened the first Disneyland park. After that it grew, it became bigger, it was rebuilt several times, they bought more land, and now they operate several Disney parks. They have their own Disney parks, but also they have like franchisees, so it's not all only their park. And from 1980 they start expanding to other area of business, so it's multimedia, like licenses of course was before, but that's how they start going. Interesting thing about general like Disneyland, that now it's like Walt Disney, right, the company called, but Roy was managing the company even after Walt died, and actually Roy changed the name. Before it wasn't Walt Disney, and he changed it because he respected his brother, he loved his brother, and to honor him he changed the company and started calling it Walt Disney. So it's kind of pretty nice to hear. I love when people do something like that. It's not like people call like Trump Tower, with their own name, for example, right? It's probably good, but when person name the company not with your own name, but with somebody else who you love, so it's kind of a good feature, which I like. It kind of gives certain points to the company, I presume, after that. So if you look at businesses, Disney is not only movies. And actually, if you look at producing content, that's only 14%. So studio entertainment, that's what they're producing, movie production. It's only 14%. I thought it was much bigger when I first started analyzing company. And actually the biggest business, 44% of their business, it's ABC, ESPN networks. Okay, it's media networks where they show not only their own content, but actually content of other producers. So it's a big one. Another big one, it's park and resort. Disneyland, Walt Disney World, which has several kind of, and also cruise lines. So I also didn't know that they have cruise lines where you can go and probably spend like few days, several days enjoying this. You don't have to go to the park, and probably it's cheaper than go to Disney park if you go on a daily basis. It's 31%. Okay, and then they have licenses and etc., etc., etc. Like it's around 9% of their business, because if they producing whatever movie, for example, Disney, like whatever cartoon and after that, Marvel, like what's the company producing toys? Mitchell, yeah, right? And they probably have to buy licenses from Disney, and they pay for each toy which they sell, and so it represents about 9% of the business. Now, I thought before that Disney is more about like kids movies, but in reality, I remember when I saw Marvel movies, you know, all these heroes, superheroes, and then I thought, okay, I want to buy Marvel shares because movie has a certain sequence story. There is always another movie after the first movie, and then another movie, and they have a lot of also smaller series. And I thought, oh, it's probably a good company. And when I start analyzing it, I realized that it's actually owned by Disney, and Disney owns quite a few studios, like Pixar, for example, right? So and it's quite good to know about that. And let's probably see here what kind of brand you can see under Disney. It's similar to Coca-Cola. When you buy Coca-Cola, you think it's Coca-Cola, but in reality, Coca-Cola has so many different drinks which they own. And when you go and buy to shop and you say, "Oh, I'm not going to buy Coca-Cola," you're probably still producing a profit for Coca-Cola too. Okay, that's kind of interesting thing about that. Okay, that's about general Disney. And again, wanted to come back to Warren Buffett. He says you need to buy the business, right, which is sustainable, which very well known, and brand is strong. And I can tell that Disney probably one of the strongest brand in the world. And I probably have never met any person in the world who doesn't know what Disney is. Okay, to become so popular, maybe some way in some countries they don't know what Disney is, but I doubt it's so popular everywhere that I was living in the Soviet Union and I still know what Mickey Mouse was and Disney. I remember when I was a kid. So it's like really strong brand which can be represented in any practical country. So and I just discussed with one of the investors, and he said, "Oh, one of the CEO is living in like 2019. Will it affect the price? It might. But remember, Warren Buffett says that you have to buy the company which can any idiot run, and because one, like sooner or later, one will. And that's why when I look at Disney, I believe that the structure of this business is so strong that even if somebody like wrong person will take the spot like as a CEO, probably it would be very difficult to ruin it because it's everything is organized. And I don't believe that one person at the top can make a huge difference and worsen the company because all the sub companies they managed by strong people already, and which is good from investment point of view. Okay, fundamental analysis of Disney. Guys, can you see properly all the numbers here? Okay, great. Now, here the price is 106. Now the price is 98, so it's lower. And also PE is lower, so it's about 16, maybe a bit lower than 16. You can see that it has dividends, 1.5%, not huge, but still pay dividends, and it's kind of an additional something like that. So value line sees it between 115 to 140 in that range, and we're going to compare where our number is, which is represents 10 to 30% growth annually. Now remember, they look at it from 106 price point of view, so now it's 98, so it's another 10% on the top of that you can add. Okay, now that's a recession, and straight away, before we analyze a lot of companies, what we do, we compare what happens if the recession hits. So we can see that the price was here at 36 bucks, and then it went to $15 from like 35 to 15. So it's like 2.5 times dropped in price. Now for us it's important, okay, what was happening within the company? Was it losing money? How much it was losing money if it was, or it just was emotional thing, okay, the price collapse. Now, and if we know that the company was strong, like growing during that time, so it represents opportunity for us in the future if something like that happens again. Okay, so let's have a look from revenue. let's start from that part. We can see that per share it was $15, 15.90, 16, 18, 20, and here it is. There was a small drop. If you look at drop from $20.70 to 19 to 80, so it's 90 cents drop, about 4.5% in sales. So sales dropped down in that crisis. Okay, whatever business they had, maybe cruise lines, like cruises, maybe some sales, maybe people stop watching too much movies, and etc. etc. But definitely we can see that sales were affected. Now, and after that, that was only 1 year, and after that, it's steadily growing. So it's 19, 20, 23, 23, 40, 25, 28, 32, 34, and this year they are planning to close $36.75. Now, for us, important to look not only at the revenue per share, but also general revenue, okay, for whole company. And if you look, you will see the same type of stability. So the company had dropped only in 2008, so 3,700 to 3,600, 3,780 million to 3,144 million. So, and then after that, it's steady growth. So it's not like BBBY, for example, we looked where the revenue for the whole company was sliding down, but per share was growing because they're buying shares. This company has growth in all aspects for the company as a whole and also per share, which is good. Okay. Now, if we look straight away amount of shares, we can see that they kind of having a buyback. So they had here 18, nearly 19, 1.9 million, then 1.8 million, 1.7 million, 1.6 million. This year they are planning 1.55 million, and then slowly decreasing. So they are buying shares back in not a huge amount, but still buying. Okay, which is good for us. Now earnings. Okay, the next stage is earnings. Again, going back to 2008 and 9. So what we can see, the earnings were growing quite steadily until that recession, and then we can see that it went from 226 to 182. So calculate what kind of percentage it was. So it's about 40%, right? Or 40%, yeah, 20% drop, okay? But the price went 2.5 times. So definitely we can see that earnings dropped 20%. They were still profitable. Company was still profitable, but the share price here collapsed much lower, okay, than the earnings. And definitely it was a great opportunity at that moment to enter a position. And you could make a lot of money by doing that. But after that, steadily growth. If you look at this, there wasn't even 1 year where the company had flat earnings, constantly growth. And this year they also have a growth. So if we analyze that company last September, from last September the company grew, and you can see that it was $4.9 per share in 2015, then 5.7, and this year they are planning $6. And then 640, 785, and etc. etc. So, and also if you look at net profit here, so you will see the same stability in growth. So earnings are growing not only per share but also for the companies. Okay, that's a great. Also, if we look at book value, we can see that book value also steady growing. But as I said before, you have to be careful with the book value here. You don't rely on whatever you can see here. I would probably go and look at the tangible book value if you want to know that more precise. But from other point, to assess book value for Disney is quite difficult, in the sense that if you buy any other company and they have a lot of goodwill, for example, remember we analyzed Richai, which is recruitment industry company, and they have huge goodwill. If you decide to close down that company, you cannot do anything with that goodwill. You're going to lose it completely. Whereas with Disney, probably even generate more than that, because if you start selling all these licenses for different products, for different cartoons, which can be used in advertisement industry, they're not tangible, they're intangible, but they will cost a lot of money to buy for others. probably would be options, to buy rights to, for example, to put some Mickey Mouse or, so white snow to different labels. Okay, I presume they can generate money from the intangible assets as well, same as from tangible assets, maybe even more from intangible than from tangible. So that's why to assess a book value for this specific company is quite challenging. At least I wouldn't probably try even to assess it, because a lot of characters which they manufacture, like produce themselves, they cannot put on a goodwill. So it means that they don't have them on balance sheet. They still can sell it, like still generate money from that, but they wouldn't be even on a balance sheet from that point. Okay, so this is kind of stuff. Then we look at margin. The good thing about margin, what I've noticed, look, the margin is growing. A lot of companies facing competition, they're reducing their margin. Look at it here. It was 20 operation margin, and they start growing, and now it's 30, and now it's 31, and now they're trying to get it to 33. So it means that they're optimizing their expenses, they're optimizing their systems, and they're making more money on each dollar invested. So, and if you look at net profit margin, it's soon going to double, because look at this here. It was 9%, and now it's 17. So if it was 18.8, so it's actually going to be like double from 2009. So this is quite good thing. If you look at the return on share equity, so whatever on the shareholders equity, so we can see it's 22. Warren Buffett looks for something above 20, and we look at total capital is 16. So we can straight away say that they have a debt, right? That's why return on total capital is smaller, right? If it was equals, similar, it means that company didn't have any debt. Now, from that structure, we can see that they have total debt 21.6 billion. Looks huge, right, for many people, but if you look at capitalization of the company, 1.167 billion, it's not that big already. So it's about 12-13%, right? So it's not huge. It's above the level we are looking for, but still it's quite manageable from that perspective. Okay, so is that part all good for you guys? Okay, I didn't show you one thing, but I'll come back to that thing a bit later. Okay, so I already told you what the company represents from itself. Like value line says that it's a good company and modest long-term capital appreciation potential. Okay, so just conservative appeal, which is it doesn't see that it's going to jump. It pays dividends twice a year. Okay, whoever wants to get it, so it's not quarterly dividends. That's their growth rates. So we can see that their earnings are growing faster than sales, and we could see it already from margin. We could guess it, right? So we can see that in the last 5 years, their sales growth was 9% annual and 18% in earnings. So it's twice as fast as their sales level. And what they're planning to have, we can see that it's slowing down. So it's 4% growth in sales and 8% growth in earnings. So again, double growth in earnings, which is pretty kind of good. We can see book value growth, dividend growth, and earnings like in cash flow growth as well. Actually, about the cash flow, the good look at this, it's always higher than earnings. So they have more cash coming in, right, than their earnings. So it's quite healthy for the company. Okay. What I've noticed, which is kind of negative, that's current assets and current liabilities. Look at this: is 16.2 billion in assets and 17.3 billion in liabilities. So it's 1.1 billion short. So they're negative here. That's probably the bad part about it. Even though they have 3.8 billion in cash, but in general, if you look at the current assets and liabilities, so it's kind of the lack of $1 billion. So if all their like suppliers will come and ask to pay them back, they will be short $1.2 billion. Okay, they will have to, but I presume they can. $1.2 billion for them, it's not that huge. If you look at their annual income with net profit, every year it's $9.8 billion. So I presume every month they are making about $700 million. So whatever they have 1.2 billion in short right now, they can make within next couple months, right, and pay back. So, all right, fantastic. All right, so I had to disconnect my, so connected to headphones. All right, perfect. Okay, if you can hear, that's fine. Now, so you like the company, okay? That's what you said, or you didn't say me that. All right, great. So the only thing, okay, we always buy companies which we like, but we need to consider if it is pricey or undervalued. So for us, it's important now to understand if this company good value for money or not right now. Compare, and we already looked at index. So if we go back to PE of this specific company, I told you that was 170. Now it's about 15 point or something, so it's lower, around 15 to 16 area. Now compare with the compare with the index right now, whole market, which is 25. It's definitely 40% lower, right? So if Disney was also PE 25, it was similar to whole industry, like I mean index market, but because it's 15, so it's definitely below the market. But secondly, let's have a look at the PE ratio average. And if we look from like sometimes it was 30, 37, 21, 20 here, right? In recession time, it dropped to nearly 12. It was the lowest probably ever. And now it's 17, 18, 20, nearly 21, and then going back to 17. Still 17. Probably they just take it from the reports, Dory. But we can calculate it. You can take $66, which they're going to have right now as a profit, and then divide by current price, how much you're going to get. So about what, 16, something like 16 and a half, yeah, something like that. Okay, so that's what you're getting. If it goes to above 100, it would be 17 probably. So it's at the lower range. If it was at a high 20, 21, it would be at a higher range. If it is at 15, 14, it's probably lower range, 16.3. Okay, so somewhere in the middle range. Okay, let's have a look at quality analysis. So if we provide this 4x4 analysis, we'll get about 43 points on that. So where do we lose points? First of all, industry ranking. So I think it's 36, so it's not ideal. Okay, so we're losing 1 point here. Then we're losing the timeliness. It's 3 as well, so it's not perfect. So it's again 8. It's average as the market. Then we're losing at debt. They have 12% debt, so it's above 10, even though it's very close to 10, so it's pretty good as well. We even can add those points back. And also growth trends, because it growing less than 10%. He took a price $98, Han, because now the price is 98. So that's why he divided price decided by earnings per share. Where is the price? The price is market, Han. You open the chart, you will see. So market price, the share price. Okay, so that's about the quality. And if we look at price analysis, so that's what we do. We take the highest prices within the last 5 years, add them together, and find the average high. Then we do exactly the same with the lowest prices. So we take all the lowest prices during those years, and we calculate the average low. And then we do similar stuff with earnings. We add them together, divide them by 5, and we get average earnings. Why do we do that? Because we need to distinguish what's the average P price earning ratio. So when everything is rosy, people are happy about the company, they are motivated, they generally happy to pay the highest price, and PE ratio would be 90 divided by 4.2, and it would be 21 times. So when everything is good and fantastic, they're willing to pay 21 times higher than their earnings. So, and if company has a projected earnings of $7.35, so we assume that this type of ratios will stay sometimes in the future. So they will be repeated again because it's average. Sometimes it could be higher, but on average, we might expect that it's going to be like that. So, and if everything rose is going to be in the future and the earnings will be as they project, so $7, we multiply it, the share price might go to around $156. Okay, and then we look at the lowest point. So when people are scared and they feared about some kind of problems and etc., etc. So in general, if we divide the lowest prices by the earnings, we can come up with a 15.6 PE ratio. So we know that in average, when everything is bad and people are scared, they're still paying 15 times more than earnings of the company. Okay, so my mistake. So even higher. In this case, the price would be even higher, Dory. Thank you very much for putting it. Probably I just, when I was inserting, I put instead of 3, I put, instead of 8, put 3. Okay, great. So that's very good. So, but generally, let's have a check. So we look at here. So that's, yeah, 7.85. So I probably saw it 8.35. My mistake. So it tells us that the highest point would be even higher. So you can put it in your worksheet, Excel sheet, and you will see that it could be even higher. So this price now, guys, is going to be above that. Okay, which is good, like even better than we expect. So, and then the lowest points. So if we assume that, okay, that's the lowest PE ratio which people are happy to pay if everything is bad, and that's last year earnings. So we're assuming that it's not going to make more money than that. So what's the price going to be? So $89. So we can expect that company might fluctuate from $89 as a lower to 100, whatever, not 56, but even higher, right? So right now, but let's see that between those numbers. So, and that could be true. Right now it's 98, so it's $10 above that price. But we already know that earnings this year are going to be $6, and it's already 2 quarters, and they're going kind of ahead towards number. And we can assume that third of that time it's going to be close to the high, third of this time it's going to be to low, and third of that time it's going to be somewhere in the middle. So that's why we divided by 3 parts equal. So, and if we divide this like about 60, whatever, $6 here, or no, $86, right? So it's going to be $20, $22 if we divide it. So, and then we can see that from $89 to $111, that's probably the buy area where we enter the position. From 111 to 133, that's what we hold, and then we can sell it already to consider okay, that prices. Now last year when we analyzed the company, the share price was $92, and after that it's moved to nearly 118, I think $120. So it's more than 20%, 25% move, and now it's slowed down again. So now it's went down by technical. So at the moment, if we look at reward risk ratio, so we have a risk of going from $97 to like $90, so $8 down, okay, less than 10%, or potentially we have a growth to $156, so it's 56% growth up. So definitely we have much higher reward than potential risk. That's based on fundamental analysis. Okay, we're not looking at technical analysis yet, but definitely if we look at fundamentals, we see that this company also trades right now at a lower like area, so probably in the buy region. Okay. Now, guys, is that clear about this particular table?